6 to 1, but it's just starting, so many stocks still yet to open up. And it's all green on the Nifty heat map. Just 3 or 4 names in the red: Infy, Bharti, Nestle, SBI Live, but everything else is starting the day higher. So it's 3-digit gains, nearly 100 points, 22,433 at the very beginning. Surabhi.
Before I talk about the Nifty stocks, I want to pull up one stock that I was actually observing for the last several weeks, and that's Castrol India. Castrol is one stock that hasn't fallen as much as the rest of the market. In fact, for the year as a whole, Castrol is still up 18% in 2025. Today, it's rallying 5%, and now we know why, because it's become very clear. Saudi giant Aramco has made its intentions clear that it wants to buy BP's lubricant business, which is Castrol, and they're very interested in key markets like India and China. So we have to get to the bottom of this, what this would mean for the listed entity here. But that explains the resilience that stock has showcased over the last many weeks, including, of course, today it's looking good. Now on the Nifty, let's look at the key movers and shakers. A lot of the commodity stocks are flying high. BPCL is about 3% higher. Reliance 2% higher. Hindalco is 1.5% higher. Tata Steel's up and about as well. A lot of enthusiasm around the whole China boost as well coming in for these stocks. Shriram Finance 2% up. Tata Motors is seeing some buying this morning. Coal India, Eicher Motors, Bajaj Auto, these are the other names on the upside. So it's a very broad move, and most parts of the large cap screen are moving higher. Relatively speaking, Infosys is the one that kind of stands out. It's seeing some selling today, but it's not the whole IT pack that's down. It's actually more Infosys. And Britannia is mildly lower, about 0.7% lower. But otherwise, it's a green-looking screen, lots of financial names. Autos definitely bouncing back, and commodities, oil and gas, metals, material stocks like Coal India, all of them moving higher.
Well, Surabhi, there's one stock I'll be looking at is Z. That stock is absolutely bombed out. And if you look at the exchange finally, you'll see the promoter has bought close to around 27 lakh shares from the open market. Remember, promoter holding was a little bit south of 4%. But now we're seeing that it's added close to around 0.28%. So that could be, the stock was sub 100 rupees and some kind of promoter buying. Keep an eye out on that stock. A big underperformer, promoter chipping in after a while. So that's one stock I'm looking at. Man Industries is another stock that's moving higher on large volumes. Keep in mind that the stock has seen a sharp correction from the recent peak. Yesterday, it was up close to, I think, 15-20% or thereabouts, Man Industries. Today, it's up close to around 5%. And the volumes are large. If I remember correctly, the recent high was 450 rupees plus. So after halving, the stock actually is bouncing back. IOL Chemicals, they have got a certificate of suitability from the EU regulator. So that stock is up close to around 4.5%. And ACME Solar, that's another company. We had the management joining us on the show just a few sessions ago. That stock, in fact, is up close to around 5% as we speak. Volumes as well, fairly high out there. They are very, very adventurous brands. Acme Solar, that should come up for you on the screen. Besides that, some of these other big movers from the broader markets. You have Root Mobile that's up and about in today's trading session. Big move is what we're seeing out there. Triveni Turbines, another stock that's up close to around 6%. So a pretty good looking screen, guys. And big boy Reliance Industries had opened up in the green. 1,220 is the 20 DMA. You'll want that big boy to get past that mark, which will brace for a bigger move if you have to see a breakout on the upside. So that's the technical level, 1,220.
All right, let's have that stock up. That's Reliance. We'll look at that. 110 points, by the way, that's RIL. So 1,200 basically is where Reliance is at, 2% higher. Well, 100 points on the Nifty is what you have, 22,450. And that is, it's looking good. And we'll see, we'll be able to build on this or not as we go along. Just a few other names where things are opening up with strong volumes. We did mention the OMC's HP, of course, is standing out with that 5% pop. Out of the 3 HPs, the biggest volume-led gainer. Castrol, we already highlighted. Triveni Turbine, Nigel just highlighted. Chennai Petro is up 5%. So standalone refiners, Chennai, and maybe we should look at the other one as well, MRPL, and 240,000 shares. So good volumes as well. MRPL is up 4%. Yeah. Root Mobile, if you mentioned that, 8% higher on Root, 1,085. There is IOL, I think we did mention 5% on IOL, 343. That'll come up. Shakti Pumps is back to being up 5%, limit up a day. It was up 5 yesterday, 5 today. But of course, I mean, from 1,200 rupee levels, it had fallen to 800 one way as well. So some recoveries coming through. Sapphire is up, Sapphire Foods, 8% higher, 334 on that. And it's got it doesn't have too much volume, so be mindful there. So let it settle down. There is Quick Heal, which is up 5.5%. First Cry is up 5%. Recent listing, First Cry. But again, I mean, don't want to emphasize too much on these names because volumes are lacking. Very small volume. They're going up on little volumes at this stage. On the downside, there isn't very much at all. I mean, I think you look at, say, 3% as the cutoff, there are two names with volumes. I mean, there may be more, but with decent sized volumes, there is Azad Engineering. And we had the management with us yesterday. So 1,300 on Azad Engineering. And there is Bharti Hexacom, which is down 3% as well. So about 1336 on this one. Otherwise, it's all, 0.5%, 1%. Narayana, of course, it made a new high while the market was sinking. So it's just seeing a 1.5% pullback. That's it. So it's a pretty good-looking, decent-looking screen at this stage. Well, we have Mahesh Patil, who's our market master of the day. He's Chief Investment Officer at Aditya Birla Sun Life Asset Management Company. Mahesh, good morning. Great to have you with us here on the program. Prashant here. Your note says, why now is the time to invest? So I'm going to just put that to you. 2-3 bullet points. Why do you think so, Mahesh?
Yeah, good morning again. So I think what we're seeing is that some of the factors, right, which were hurting the growth and the slowdown what we've seen in the first half of this fiscal year, I think some of these things are easing off. Clearly, we see from the fiscal side, there's a boost to consumption, which is there. I think which should kind of translate into better consumption growth, which was weak. On the monetary policy side, we've seen that the tightening which was there in the first half, we've seen that starting to ease off a bit. The policy environment, the new RBI governor has come on board. We've seen the rate cut. We've also seen a great amount of liquidity infusion. Yesterday, they infused around 1 lakh of OMOs to reduce the system liquidity, which was a negative already. And I think that should also spur kind of a growth. So we see, I think, even the GDP number which came in for the third quarter was around 6.3%. So I think we are probably well on track again on recovery over here. And next year, we should be around 6.5% GDP growth. And even the corporate earnings growth, which this year has seen a big downgrade to earnings, I think slowly, it should start to recover again from the second half of this calendar year. So that's on the fundamental side. But more importantly, I think on the valuation side, after the recent correction, both in Nifty and also in the mid and small cap indices, and the Nifty, at least the valuation now is slightly below the long-term average, the P multiple, if you look at it. And mind you, if you look at the ROE of the Nifty is well above the long-term average. So that means clearly the market, the risk-reward here looks favorable. Having said that, markets can always undershoot on the downside, but clearly for a long-term investor who's looking at a 3-year view, I think this is a good time to dip in. And recently also we've seen that a couple of other positives in terms of oil prices, which have come down below 70. I think that should help to contain inflation. And with that, I think there's a good chance that in the next policy, again, you could see a rate cut of further easing, which could be possible. And also on the global front, the DXY, which was kind of rallying, and we saw sharp rally since September when Trump elections came to power. But that is also now kind of easing up and stabilizing. So I think the pressure of the rupee is also kind of now stabilizing. And the rupee depreciation actually is a kind of a boon in terms of earnings, because I think once this rupee stabilizes, the 5-6% correction would mean that the top line growth of a lot of companies, if you look at 50-60% of the top line of corporate India, is somewhere linked to the rupee dollar rate. So that should also, I think, once settle down in the next financial year, that could probably add a bit to the earnings. So I think we think that the worst is looking in. The overall indicators, like if you look at the breadth of the market in terms of number of stocks, which are below 30%, that is at a kind of a highest level what we have seen, except during the COVID crisis and during the global financial crisis. So clearly, it is oversold. It's a good time for long term to really step in, and you might see a slow and gradual recovery from here.
Mahesh, hi. Good to hear that. I think that's almost the near consensus view that it's a good time to start adding to positions now. Perhaps we've seen the worst. But the question is, what next, right? this market since COVID has been used to these quick bounces, V-shaped recoveries, right? And it's usually been a very momentum-heavy market where stocks overshoot on valuations on the upside, PSUs, etc. So the question is, from here on, should you create a portfolio for a longer period of consolidation, maybe a more defensive portfolio for the next 1.5 years, or should you, create a portfolio with animal spirits, which means go back to industrials, go back to stocks, the usual names, whether it is EMS, industrials, capex, etc., which led the previous arm or the previous leg of the bull market. What is the approach you would take?
That's a very good question. So I think we would not see a kind of a sharp recovery. I think the market momentum clearly has broken, right? We've seen in the last 6 months or so. And there is some amount of pain which is there. Even the corporate earnings recovery, will be slow and gradual. So, and on the global front, we'll hear these noises. So I think it will be a market where you will see some bounces, some correction, and it will probably consolidate for some time, right? Because this correction started around since September, so we are like less than 6 months. Normally, it will take at least a year, where the market consolidates and tries to make a new high. That's first. Secondly, is that I think whenever this market undergoes such a sharp and deep correction, what we see is that the sectors or the themes which were doing well in the earlier part of the rally, that leadership starts to change and new sectors starts to emerge. So I think some of the sectors which did very well in the earlier period because of either the growth momentum or because of the liquidity flow which rallied behind some of these stocks, I think that will likely to change. And that's why we think that in this going forward from here, you will see sector leadership clearly changing. For example, like banking sector, right, which has underperformed in the last cycle. We see that sector doing well. Again, a lot of the headwinds there, which were there from the regulatory side, I think that is starting to ease off a bit. The earnings growth will not be as great because rate cuts happen, but a lot of that is priced. Valuations are reasonable. And if recovery happens in the economy, you see credit growth again coming back over there. Similarly, sectors like, for example, the cement, metal space, which have kind of underwhelmed in the previous cycle, I think these could probably come back. And amongst the sector leaders, which was in the earlier cycle, I think wherever the corrections have happened and valuations have become reasonable, and the growth outlook is fairly good, whether it's in the industrials, capital goods sector, I think it will be more stock specific, I think, going forward in those sectors.
Okay, all right. Hi, Mahesh. Good morning. And you're sounding quite optimistic. The other data point was on the technical front. I think the number of stocks in the NSE 500 that were trading below the 200 DMA was the highest. I think even in peak financial crisis, we didn't have 90% of them were trading below the 200 DMA. So that's telling you the kind of pain that we saw from the broader markets in particular. But as you've highlighted in your note, asset allocation is going to be key because you have limited money. But now, how would you allocate money? How much to equity, how much to fixed income, and how much to, say, gold? What is it right now? And how has it changed, say, in comparison to 6 months ago? Because at that point of time, I think equity could have been relatively lower. Now, going by what you're saying, you'd like to up the ante, I think, out there. Tell us.
Yeah. No, okay. So I think, by and large, I think what we're seeing is that the risk return across asset classes, right, is going to be reasonable compared to the risk-adjusted returns long term. So fixed income also, we think this year can be a good year. Where you could make 8 to 9% return as interest rates come down. Gold is a good hedge. We've seen that play out last year also, the early part of this calendar year. So that will provide this stability. So asset allocation fund would be a great approach for investors to time the volatility because we don't see any oversized return in any particular asset class. So that's the first thing. And in terms of asset allocation, so we run a asset allocation, multi-asset allocation fund and balance advantage fund, wherein we express our views in terms of what is the allocation towards more between equity and debt. So in that fund, our allocation, for example, around 6 months back, used to be around, we were going as low as around 37% or so, and we were around 14% for quite some time. And in the beginning of this calendar year, we slowly started to increase because some of our indicators in terms of the valuation and also some of the counter-cyclical indicators which we look at. So that started suggesting that starting time to deploy. And currently, we are around 62% in that fund. So that suggests how we have moved asset allocation as the markets have corrected and some of the counter-cyclical indicators are suggesting that this is a good time. to really enter into the market. Having said that, there could still be drawdowns in the market. I think we're not seeing that there won't be drawdowns, but I think those drawdowns are periods, okay, where one needs to buy because there is really now, at least as a fund manager, I see good value emerging in stocks, okay, which really want to buy from a long-term perspective, which earlier you couldn't really because the valuations didn't really fit into your growth valuation framework.
So the current percentage is what? Equity, debt, gold? Sorry, we just missed that.
So
The exact
currently
numbers.
in a balance advantage fund, okay, where it is only debt and equity, it is around 62% currently. And in a multi-asset allocation fund, okay, where we don't do too much of our asset allocation shift, but there our equity allocation is around 62%, gold and silver is around 70%, and balance is into debt. And also, we find REIT invest also kind of attractive, okay, because they offer IRRs anywhere between 10 to 11%. So we have exposure of around 4 to 5% on REITs and investments.
Okay, all right, Mahesh, we will wrap it up on that note. Thank you very much for joining in and giving us a sense of how to approach the market now after what has been a 6-month-old correction, prolonged correction. Is it over? Well, we'll only know in hindsight, but the last 2 days have been good. In fact, the market, look at that. Look at what's happened. Now, this is exactly the problem that did not occur yesterday. The bounces were not getting sold into. It was a great positive. But this morning, there is some uncertainty. And I think this whole business with, till now, it was everybody else's problem. We were watching on the sidelines, US, Canada, Mexico, China, who's levying what tariff, counter tariff on what. Now it boils down to us. What is the deal that India can negotiate with the US with respect to tariffs? And if we indeed have to bring down import duties to zero on a lot of products, how is that going to complicate further the local growth landscape? I think that's a bigger macro issue. But the market anyway is choosing to sell off for the time being.
I have an easy explanation.
Okay.
I just stepped out to take a call.
Okay.
The market sold.
That's true. Our lucky mascot was missing. Now it should turn around, right, from here.
But it's as you said, it's a sharp. I mean, it was up when 100 points up, and now it's down about 10 points or so. So, yeah, I mean, more on this coming up. But I think we have the management of REC with us.
Yes, we do have, REC, the management joining in. And, of course, power financiers have been in focus as well. A recent brokerage note said that the structural story for power financiers is very much intact. And that note largely is saying that due to lower credit risk, strong ROEs and valuations, many of these stocks are still looking good and they're inexpensive. This was a foreign brokerage that wrote. CLSA gave that view on REC and PFC. So how is the actual business on ground? Well, joining in to understand that, we have the CMD Vivek Kumar Devangan, ED Finance Harsh Baveja, and VK Singh, the ED Projects. Thank you very much for joining in, Mr. Devangan. I'll start with you. Good morning. So as you can see, I mean, the markets are still holding on to hope that your numbers will keep looking good as we go forward. But before the growth question, I want to come to the question in terms of your borrowing mix and the cost of funds, because the RBI has been taking increasing number of steps to boost liquidity in the markets. If you could just explain your borrowing mix right now to us and what the future has in store, the near future, in terms of margins. Can investors hope for any increase?
We use a judicious mix of our borrowing. Our 40% of borrowing is from domestic corporate bonds. About 18% is from domestic bank term loan. And we have an instrument called 54EC bond, that is capital gains tax saving instrument, that constitutes about 10% of our borrowing. And our external commercial borrowing is around 30%. That has also, we have used hedging techniques, innovative hedging techniques, and we have been able to bring down our cost of fund to about 7.15% at the end of Q3. We hope that we'll be able to hold on to our spread of about 2.94 to 3% and net interest margin of 3.64% to about 3.7% going forward.
Gentlemen, it's so great to see the full strength of the REC team. Mr. Devangan, Mr. Baveja, Mr. Singh, on the finance side, project execution side, and of course, Mr. Devangan, as we always speak with you. So it's good to see all three of you here. Just give us a sense of, Mr. Devangan, how 2025 really will pan out in terms of disbursements, pace of growth. Is is the focus on renewables absolutely going to remain unaltered? The reason I'm asking that is because, US is the big source of capital around the world. The US seems to be changing direction ever so slightly. And everybody else seems to be following the lead. Will we see any change in, of course, it will have to come from the government in that sense, but what is your own perspective, sir? If you can give us that broad sense, and we'll go back into micros again. Go on, sir.
Yeah. As far as the disbursement is concerned, you might have observed that our disbursement had increased by 19% at the end of Q3. And last year, total our disbursement was to the tune of about 1,61,000 crore. And happy to share with you that we already crossed that mark in the current financial year. We already crossed disbursement of about 1,68,000 crore. And we hope that our disbursement will be increased as compared to last year in the range of 18 to 20%. And since we have large pipeline of projects, we already sanctioned number of projects, particularly with regard to renewable energy projects. As I had told you earlier, that on the sidelines of Energy Transition Working Group in Goa in July 2023, we had signed MOUs worth 2,86,000 crore. And I'm happy to share with you that we have already sanctioned projects more than 1,60,000 crore for those MOUs. And we have a huge pipeline of projects, and we hope that our loan book from renewable energy, which is at present 10% of our asset under management, which will go to about 30% of our asset under management to the tune of about 3 lakh crore by the end of 2030.
All right. Hi, sir. Good morning and good to see you all in. Just to reconfirm the numbers for this year, disbursement growth you're guiding for high double digits. Is that correct? And NIMs you mentioned about 3.6%. Is that the number?
Yes, disbursement would be around 18 to 20% increase, and NIM will be about 3.64% to 3.7%.
Got it. Okay, all right. So we've got that cleared out of the way. The other big factor that the street will be looking forward to is going to be write back of assets and resolution of assets as well. So could you tell us how much has been done? For this year, what is the number we should work with? And for the following year as well, what kind of number should we work with?
I'm happy that you asked this question. Today, we are going to get about 2,600 crore payout from KSK Mahanadi. Our recovery from KSK Mahanadi is going to be more than 100%. Total, the proceed that we are likely to get in the month of March is about 2,764 crore. We have also got very good resolution from Bhadreshwar project, which has, there also we are getting very good write back. Then senior plant in Nasik, there also our recovery is going to be very good. And Hiranmai in West Bengal, there also our recovery is going to be very good. The total write back that we are assuming, it may go around 2,500 to 3,000 crore in the current financial year.
Sir, one more point, and I want to draw your attention, and maybe the others on the panel could also take this up. There was this report that the IMF put out, and what the IMF study is saying that NBFC's concentrated exposure to large infrastructure projects, specifically state-run, state-controlled NBFCs, this large concentrated exposure, this could perhaps in the future start creating some systemic risks for the financial sector as a whole, for financial sector stability. Your thoughts? I don't know if you saw this report, Mr. Devangan, and maybe Mr. Baveja can chip in, whether this causes any room to worry. I mean, it is the International Monetary Fund and their study that's throwing this up. They did not name REC or any entity in particular, I think, but they're saying large state-run enterprises that fund infrastructure. There could be a systemic issue over here. Sir.
Yeah, there have been some concern about the debt sustainability of the state utilities. But as we go by the history, not a single state utility has defaulted so far, and they are supported by the state government guarantees. And we have made a detailed analysis actually for the state utilities because there have been concerns about their debt sustainability. So we are taking due precaution, and additional prudential norms have been stipulated by Ministry Power that we are strictly following so as to avoid any unnecessary exposure. And we are ensuring that close monitoring of this project is being carried out by our project monitoring group. I'll request my Director of Finance to substantiate further on this issue.
Mr. Baveja, are you seeing pockets of stress build up anywhere? And is this this concern on systemic stability, financial sector stability, is it valid?
No, their point is very valid, but I'll come to from the perspective of the REC. That we have 88% loan book consists of the funding to the state government and state government agencies, and 12% is from the private sector. So as far as the state government fundings are concerned, we have never experienced in the last 10 or 15 years any kind of restructuring request, all the delays in the repayments, all the NPAs accruing. Bearing one or two cases where they have slipped to the stage 2, but that is a regular phenomena. Sometimes administrative delays are there. So we have a robust appraisal system, and on the basis of the revenue sustainability of the project, we used to fund the projects. In case if any of the projects which is non-capex, generally from the state government utilities, we take the loans, we disburse the loan against the government guarantee. So the loan is properly secured.
Got it. Just one more question on financing. There was a recent media in that 12%, which is to the private IPPs, etc., private sector, Mr. Baveja, there was another article recently which said that the RBI has asked financial institutions to stop giving lines of credit to corporates. Is there any, generally that is not there as a practice. It's not widespread now, and I'm assuming those can be replaced with term loans. But at REC, is that a practice at all, Mr. Baveja?
That point is very well taken. In fact, what is happening that we don't give any kind of working capital funding to the private sector. And as far as the government sector is concerned, government utility distribution utilities are concerned, the government of India has already mandated that there should not be more than 35% of this. They have kept a ceiling of 35%. So beyond that, we cannot give them the working capital limit. So taken all together from all financial institutions, their working capital limit will not exceed the 35% of their revenue for the last year. So we are keeping that ceiling intact, and within that limit, we have given them, if any working capital limit is sanctioned, that is towards that, and that is within the ceiling.
Okay, just a final point, and again, we're just kind of trying to check if some of these reports are valid or not, and whether these concerns are valid or not. Mr. Singh, if I could come to you for this quick last bit. There are some press reports indicating that on the renewable side, there's a bit of an issue because there's a mismatch between the renewable, generation, the capacity, and the transmission capacity. So, some several gigawatts, I think 60 gigawatts is the number that's doing the rounds, that kind of, capacity is stuck. How much is REC right now lending to renewables? I mean, as a percentage, how much is, traditional thermal power and how much is renewables? And are you noticing this, on the renewable side? Is this becoming an issue in terms of the repayments that you would expect?
So, in terms of loan book, renewable energy constitutes roughly 10% of our total loan book. And whenever we take up funding of any renewable energy project, we first ensure that the evacuation system in particular is in place. So when a project comes up for lending, there are multiple things. And the prominent about those multiple things is PPA, availability of PPA, availability of connectivity, availability of entire evacuation system, and then only we take up the project for lending. So as such, in our lending, of course, this is not an issue, but yes, in this sector, there are minor issues in terms of evacuation, but the lot of work is actually happening on this particular front, where evacuation perhaps as of now is not a constraint in evacuating renewable energy power.
Okay. Just one more thing, Mr. Singh, on the infrastructure side, that's a fast-growing area for you. What could you tell us? I think you sanctioned about 20,000 crores worth of loans last quarter. What's going to be the growth here in this segment?
Earlier we were taking up this infrastructure project quite seriously, but then there were many opportunities, particularly in thermal generation space, and many projects actually came our way. So we are now, again, our hands are full with, power sector projects financing. So we are not that much focused on infrastructure lending as of now, since there's a lot to do in power itself. But we are doing small bits in infrastructure lending as well.
Okay, enough to do in power. So that's the focus. Thank you very much, all three of you, Mr. Singh, Mr. Baveja, Mr. Devangan, appreciate the three of you coming on and speaking with us here for our audience at CNBC TV18. We'll take a quick commercial break here. We have the management of HUDCO coming up next to discuss demand trends going forward. Stay tuned.
Welcome back. The color has turned red on the screen, not just for the Nifty, but the Bank Nifty as well. Both those indices are down. Saving grace is mid-caps. Mid-cap index is still holding on to gains of around 0.75%. So it's one of those mornings where the opening gap up gets sold into. Let's see, it's still a long day. Maybe we'll have more waves of buying as we go along. Right now, we are moving on to the next company in focus, and HUDCO is the one that we are talking about. We have with us Mr. Sanjay Kulshrestha, Chairman and Managing Director at HUDCO, joining in for some perspective on how business is shaping up as the financial year is now almost coming to an end. Mr. Kulshrestha, great to have you on the show, sir. Thanks for joining in. So I remember our earlier good morning. I remember our earlier conversations with you, and HUDCO has been, of course, very, very ambitious in terms of growth, especially near-term growth. You've told us the next maybe 1 to 2 years will see frenetic growth. It could be as much as 30% plus before the CAGR stables out. So just to talk about how this year is ending for you, can you give us some sense of how the fourth quarter has been? And it's this quarter where the RBI has taken a lot of measures in terms of boosting liquidity. You've got a rate cut as well. So is that giving a bit of a tailwind to margins?
Yeah, thank you so much. And I will start from the background that the government of India has now more focused and more taking measures on an expeditious manner for creation of the infrastructure for Viksit Bharat. And HUDCO is a company which can fund across the sectors, starting from the water, sewage, roads, energy, power. So each and every infrastructure sector required a capital infusion. During Q3, you may have seen that our growth was phenomenal, and our loan book was closed at around 1.1 lakh crores, which was increase of around 41% on a year-to-year basis. So I think the tailwinds are with us, and we are very hopeful because generally in financial institution, Q4 is the best quarter for the financial institution. So we are very hopeful that we will be closing this quarter on a big bang, and you can see that already we had already borrowed around 44,000 crores from the market, and we have an ambitious borrowing plan of 55,000. So the indicators are very clear that the growth is coming to be there for the company.
Mr. Kulshrestha, again, I remember our last conversation so clearly where you said that the focus, housing obviously remains a focus for HUDCO, but large infrastructure projects, urban infra, that is something that HUDCO is now increasingly getting focused on, right? So if you could just tell us, roughly speaking, by the time we end FY25, out of your total loan book, what will be the ratio between housing and urban infra? And on urban infra, just before you joined us, we were chatting with the REC management. So I'm going to ask the same question to you. There are concerns. There's this IMF report that everyone's talking about, which is saying that, large state-controlled enterprises, lenders to infrastructure, they should be very careful. Otherwise, there could be systemic issues that are arising. Are you seeing any stress in your urban infra book? And how big will the book be by the end of this year?
Yeah, we had gone through the IMF report, and from the very beginning, if you see, we are very, very careful and vigilant while financing the infrastructure project. And this process will continue, and we had to further strengthen our governance system regarding the delegations and regarding the process and the procedures for the sanction and the disbursement of the loans. So we are very, very careful. And you may see that our NPA levels are the best in the market. Our net NPA is only 0.27 and gross is 2.42. And we are possessing to become a zero NPA company within 18 months of time, and all the efforts are being seen. At the same time, we are very, very careful while sanctioning the project. And during last budget, I will just like to give the example that what the government of India is thinking and doing. Honorable Finance Minister has came out with Urban Challenge Fund, which is extending 25% subsidy for urban infrastructure creation. And it is 1 lakh crore subsidy they had announced, the government has announced, and it can channelize around 4 lakh crores of the project. So all these projects can be funded by HUDCO, and only 50% bankability has to be seen, and 25% balance will come from the state government. So you can see with 50% bankability and on 100%, and 50% coming as a subsidy or grant from the government of India and the state government. So we are very hopeful that the large infrastructure projects will come, and HUDCO will be funding, and the bankability will always be there, and we will assure and ensure that there will not be any compromise on these kind of measures.
And what's the mix, sir? End FY25, your loan book, what will be the mix between housing and non-housing?
Mix will be around 60-40 because PMAY 2.0 is yet to take off, and projects are sanctioned, and I think in first to second quarter, the things will start moving, and our disbursement under PMAY 2.0 will also start coming. So we are very hopeful that by 26-27, we will be around 30-70 kind of ratio.
30-70 as in 70 urban infra and 30 housing?
True. Because now we had moved from housing. We are no more a housing finance company. We are an infrastructure finance company. So we have to move.
Okay, all right. So if you could give us a couple of numbers. I recall at the start of the year, you were talking about 1.2 lakh crore. You're already at around, I think, 1.15 lakh crore. So what do you end this year? 1.18. So you're almost there. What's the revised target? True. What do you end FY25 with? What about FY26? I think earlier you were talking about 1.5 lakh crore approximately, I think so, for the next year. So how would you like to revise this number? And also just give us some color about how state project implementation is progressing. Because, the CAPEX spend for FY25 has been underwhelming. But for FY26, the optimism is there. So give us a couple of numbers, sir.
Yeah, actually, if you see the numbers, I will retain my numbers of 1.2 and 1.5. And this year, I am very, very hopeful we will be crossing by far this 1.2 figure. And similarly, correction has to be made in FY26, looking at the opportunities present in the housing and urban infrastructure. So definitely, there will be an upward revision, but we will take a call in first quarter of the next financial year. You are right that there are a lot of emphasis in FY26 for infrastructure project. FY25 was a bit slow, but I will not say a bit slow because the time we had taken for our policy revisions, and Government of India has came out with a very wonderful budget for the infrastructure. And you had seen that for urban infrastructure, for our ministry, they had allocated around 97,000 crores. It includes the metro, it includes the housing, it includes the industrial housing as well. So Swachh Bharat Mission, Urban Challenge Fund. So all these things have been prepared in last financial year. And now I think there is a lot of scope and leverage that these kind of measures will ride a economically developed kind of infrastructure to be created.
Okay. All right, Mr. Kulshestra, we'll leave it on that note. Thank you very much for joining in, and good luck with all those plans.
Thank you so much. Thank you very much.
I really appreciate you being with us. Okay, quick check on the market. Still the same story, but the mid-cap index is also now narrowing its gain. Let's pull up the mid-cap index and the advanced decline ratio. This is the Nifty story. There's a bit of a bounce right now. Mid-cap is getting a little volatile. Advanced decline ratio is still very positive. I mean, you've still got almost 2,000 stocks advancing. Let's see how it progresses very early on in the day. Moving on, Elon Musk can't be successful here in India. Those are the words coming in from Sajjan Jindal, chairman and MD of the JSW Group. Now, he's saying that Musk cannot produce what M&M and Tata Motors can do here in India. He's also said that to become successful in India, is not an easy job. And all of this in conversation with our colleague Shireen. Shireen caught him at the sidelines of the EY Awards last evening. Take a look at this.
Everyone perhaps has watched President Trump's address to Congress this morning. It's the longest address in US history at over 1 hour and 40 minutes. And there was plenty there in terms of trade, tariffs, and so on and so forth. You know, the Prime Minister speaking just 24 hours ago said, it is time for Indian industry not to play spectator. Indian industry needs to rise to the occasion, needs to take up the challenge, needs to go out there and become a part of global supply chains. As you look at what's happening around us in the world today, Mr. Jindal, do you see this as an opportunity or as a threat to India?
No, I think Prime Minister Modi has already talked about it, that this is our time. India's time, and we have to go out there and be the part of supply chain. And I completely agree with it. Trump will come and go. There will be this Trump or another Trump. This will continue to happen. So we have two opportunities in front of us. One is to build this nation, India, which by itself is a huge marketplace, and we don't have to fear anything. We have to build it. We have to really put our best foot to build this nation and build it well. And we are very fortunate that we are at this time, we are here to build this country, and we are really doing it. Second is that we can really be a part of the global supply chain. Indian companies are very good at it. We have an extremely good cost structure. We have a very good skilled manpower. And we are already we are a very good supply chain partner of the world industry. And we need to really expedite that, and we have to expand that. So I'm very clear and very confident that we can really do that.
You're confident that we can do that, but the lament of the government, and this is from the finance minister, more recently the chief economic advisor, once again saying the private sector is not doing its part, private capex is not picking up. Why, if you believe that all of these opportunities exist and this is the moment for India, why are we still not seeing private investment pick up?
I mean, so in bits and pieces, private investment is happening. I wouldn't say that private investment is not happening. If you were to look at what JSW is doing, we are really investing and investing like hell. So there are many groups which are investing, but across the board, I would say the investment, the numbers are not as much as it should be. But I think it's time that private sector.
Is it a confidence issue? Is it a capital issue?
It's more of a confidence issue. I don't think capital is there is any problem with the capital. There is enough money out there. Actually, money is really chasing good projects, good investments. So that's not a problem. It's the confidence issue.
You know, speaking of risk-taking ability, let me come to you and get all three of you to actually talk about this, because it's very different how you're all going about this. As you said, you're investing, in your words, the hell out of it at this point in time across different businesses, Mr. Jindal, including the latest foray into the electric mobility space. Now, you know, should you go wide? Should you go deep at this point in time in an uncertain environment? You're throwing everything at the wind at this point in time, from cement to paint to sport to infrastructure and so on and so forth. Conglomerates at this point with an uncertain environment, do you believe that the risks are higher, or do you believe you've actually been able to diversify your risks by being a conglomerate?
So I think, you know, we are at this moment in time, I'm repeating this sentence, we are here, right, in India. India as a country, I don't think there is any country in the world which provides the kind of platform that we have been provided with today. So I believe personally that anything that everybody, so many entrepreneurs are sitting here, you can pick up anything, and if you put your heart to it and do it passionately, honestly, you will be a successful guy. There's absolutely nobody can stop you from being successful. Anything. I mean, for example, we are not in the paint business, or I'm not in the auto business, but I'm 100% sure.
We are hoping to get into the paint business.
Yeah. No, I'm saying I've invested in that, and I'm putting now my heart and soul in the auto business, and I'm 100% sure that it'll be a super successful. There's nothing can stop me from being
Nothing
successful.
can stop you.
Nothing can stop me from being successful. So I know Anish is here from Mahindra and Mahindra, but I know that it will be a super success. Because this country needs a huge amount of autos, huge amount of good quality stuff.
It needs Elon Musk as well.
Elon Musk is not here. He is in the US.
Well, he's likely to come. He's likely to come if the
He can't be
duties are cut.
successful in this country.
Why
I
not?
can tell you.
Why not? Why can't Elon Musk be successful in this country?
Because we Indians are here. We are here. He cannot produce what Mahindra can do, what Tata can do. Not possible. He can do under Trump's shadow. He can do in the US. He's super smart. There's no question about it. He's maverick. He's super smart. He's doing this spacecraft and stuff like that. He's done amazing. So I have nothing. I don't want to take anything from him in the sense that he's too smart. But to be successful in India is not an easy job.
Let me pick up a debate that started in Mumbai by your peer and your colleagues. Mr. Uday Kotak started it off saying that, look, Indian entrepreneurs and the next generation specifically needs to get out there, work hard, and not get into running family offices too early on. It was followed up by Harsh Goenka saying exactly the same thing, that, look, we need the entrepreneurial spirit back. We need Indian entrepreneurs and the next generation to sweat it out, as opposed to speculating, trading, and running family offices. Sajjan Jindal, do you believe that the next generation is happy running family offices as opposed to running businesses? And is this a problem?
So Uday is a very good friend, and we always spar on topics. Yeah. And on this point, I agree with Uday that the next generation tends to use the money which the father has earned and invest rather than working himself, right? So when my son came back from Harvard and he wanted to start a venture fund, and he picked up one company in Bangalore and he said, I want to invest in this company which was making EV two-wheelers. And I told him, so I also said, okay, this is his first project. He wanted to, so he said that, Dad, why don't you come along with me? I said, okay, I'll come. Went to Bangalore, visited this factory, amazing plant, amazing product, and but then I came back to Bombay in the aircraft. Parth asked me, what do you think about it? I said, not at all a good idea, because I want you to work, I want you to make money and not use my money, what I have earned over the years, and then multiply that. That's not my idea. So, and then he changed. And then later on, I think Pavan Munjal invested in that company. What we were to invest, Pavan invested in that company. And, but that's because he earned the money himself. So not his son did not invest. So, so therefore, I completely agree that the next generation, but to a point, Harsh Goenka's son is smarter than Harsh Goenka, right? And he's really doing an extremely good job. So to say that and Uday's son, Jay, is extremely smart. Yes. And he's now working in the bank and doing extremely well. So the next generation, most of them are extremely smart, smarter than us. My son is smarter than me. And most of our sons, our daughters are smarter than us. They have to be given the right direction by the parent, that you need to invest, you need to work hard, you need to build yourself and not use your father's money.
Oh, what a lovely, lovely exchange. That's Sajjan Jindal agreeing with Uday Kotak, urging India Inc. to nurture that spirit of entrepreneurship in their next gen as well. Really lovely thoughts over there. We'll take a break on that note, come back on the other side. Manisha Gupta is going to join in with the latest from the commodity world.
You know, the market has turned and market has changed. So we were up strongly 100 points, then we were down 80 points, we are up 20 points now. So a fair bit of volatility is what you're seeing, but it's not staying down. That's the more important thing. And I don't think the market breadth faltered at all through the course of the day. This is what we've been saying. Well, the focus has been large caps, but broader markets for the last 3 days now, all of this week, has looked like it wants to bounce. And it indeed is bouncing. So 2% yesterday on mid and small caps. Today there is again 0.75% on mid caps, and the small cap index will come up on your screen as well. Actually, if anything, broader markets have become, at least the market breadth on my screen, 2,100 stocks are higher and 400 stocks are lower. So 5:1 in favor of advances, irrespective of whatever else is happening as far as Nifty is concerned. Mitesh is with us with what he'd want you to do in terms of indices. Is there a trade? And of course, stocks. Mitesh, your take an hour in.
So, Prashant, first thing, I think, we kind of topped around that 23,450, 500 mark, fell off nearly 200 plus points from there. And I think that was a good entry point. So anything close to about 22,270, 250 is the buying zone right now, and 22,450, 500 remains the supply point. The directional bias on the hourly charts is positive, so I think I would still be, wanting to buy on that decline. And only below 22,200 would I be, worried again about the market. So one, I think it's been choppy, yes, to begin with, but as you rightly highlighted, the breadth was good, and the market direction to me on the hourly chart still remains positive. So again, because there's a significant supply at higher levels, I think anything 22,450, 22,500, that zone, once you get close to that zone, I would advise profit booking. But on the stock side, we're trading with long bias, and after a long time, I think, I have two paint stocks as recommendations. So Asian Paints is a buy with a stop at 21.85 for targets of around 22.80. And Berger Paints also on the buy list. I think there's some crude effect playing over here, but the chart patterns are extremely good. So Berger Paints is a buy with a stop at 487 for targets of 510.
Okay, all right. Got that. Thanks very much, Mitesh, for that. Let's now go across to Manisha. She's joining in with a roundup of all the big headlines from the commodity universe. And Manisha, the biggest headline and the best headline for us is that Brent oil is below $70 a barrel. What's the latest?
Oh, well, yes, it's below 69 as well. And we did see prices fall below 68 at one point in time as well. So sharp declines coming in for the crude oil prices, positive for the Indian markets and major importers for crude as well, for that matter. 2.5% of a cut is what we've seen in the overnight markets. And with that, we are trading very close to those 3-year lows. We've seen levels of 68.6 on the lower side for the Brent prices. And for the WTI, the US crude prices, we've seen prices slip below 66 as well. So if we see another 0.5% of decline, then we are very close to those 3-year lows coming in back yet again. So if you look at the damage on charts, that does look quite severe right now. 2.5% of decline in the overnight markets. And with that, we are down 5% in the last 1 week. And the last 2 years actually have been negative for the crude oil prices. 23 saw 11% of a decline, 24 saw 3% of a cut, and in this year until now we are down by 7% in case of crude oil prices. So after 2 years of decline, this is going to be a third straight year where we have started on a weaker note, and the way the matters or the factors are going, it does look like that this could be a weaker year for crude as well. Let me bring on those fundamentals for you then. To begin with, the US crude inventories have continued to rise, and we are looking at the US production hitting all-time highs in this year with an expectation that we would be looking at 13.6 million barrels per day of a production coming in from US. The second point is it's not just about the non-OPEC countries. The OPEC countries also are looking to increase production from the month of April. The Russian sanctions, if that go away, you could be looking at more oil coming into the markets. And the third point really comes in about tariffs there. If tariffs do come the way they are coming in right now on Canada and Mexico and China, and then retaliatory tariffs that we are looking at into the markets as well, US also will be charging 10% surcharge on energy when it comes from Canada. So all of this is bothering the markets. Slower economic growth, weaker oil demand is what is keeping the prices on the lower side. But this clearly is a story about two different worlds. On one side, you have the crude oil prices, which fell by 2.5%. On the other side, you have the copper prices, which gained up by 5.5%. In the overnight markets, we're trading at a 9-month highs in case of copper prices right now, where support comes in from the possibility that US could be looking at potential tariffs coming in for copper as well. This is after steel and aluminum already have seen tariffs there. Apart from that, China has been buying very strongly, and China yesterday also said that they will be buying into tangible commodities is the reason you've seen many of these metals continue to gain up. So even as the US copper inventories have been declining, the LME and the Chinese copper inventories have been increasing. With the kind of gains that copper has seen, we are up by 7% in the last 1 month and up by 16% in this year until now.
All right. Thank you very much for that, Manisha. We'll take a quick commercial break here. We come back with our special segment. It's the economy. Latha in conversation with the top CRISIL team on their just released India Outlook report. DK Joshi and Mirain Loda coming up on the other side.
Welcome to It's the Economy. Now, India is expected to grow at 6.7% average from 2025 to 2031. And this will be led by faster growth in manufacturing value added. That's the report coming in from rating agency CRISIL in their annual outlook. The agency expects manufacturing GVA to grow by 9% from 2025 to 2031. If you take the last 10 years average, that is 2011 to pre-COVID, then the average manufacturing growth was only 6%. Now, coming to the current year, that is the upcoming year, FY26, CRISIL's GDP forecast is more modest at just 6.5%. But clearly, they are seeing an uptick thereafter. Why do they see that? I have with me the top CRISIL team to discuss their annual outlook report. Joining me is the Chief Economist, DK Joshi, and Miren Lodha, the Senior Director, CRISIL Intelligence. Miren and DK, thank you very much indeed for joining me. DK, let me start with the here and the now. At the moment, the market is of the view that the terrible Trump trade that played is over and done with. And now, you know, the dollar index, the DXY, has gone back to the pre-Trump level of about 104.5. Do you think this is temporary relief? The Trump trade is over?
Well, I don't think it's over, because if you look at what has been communicated so far, I think there are reciprocal tariffs, then there are non-tariff barriers, and also I think there is you may look under the hood of exports of the countries, where are they sourcing their materials from. So I think I look at in that framework, I think it is still evolving. Yes, I think there seems to be a temporary reprieve right now, but let's wait for things to play out. I think the tariffs are also, reciprocal tariffs are also going to hit us by April 2, I think. So I would say that there is some reprieve right now, but I'm not too sure whether this game is over as yet.
No, you may be right, because, you know, Mexico and Canada hurt them very badly. They are completely intertwined with the US economy. But with China, they have not walked back on any of the tariffs, so they may not walk back on tariffs from India. In fact, one of my colleagues, Parikshit Luthra, is actually breaking a news saying that they have insisted on zero rates on all imports from India. So I agree with you that we have to keep that in mind. But if you keep that in mind, where is the confidence that even the 6.5% FY26 growth will materialize? Would you now want to, you have said downside risks. How bad can it get?
Well, I think this is our base case forecast. I think assuming no major disruption. I think so. One is that we expect normal monsoons to play out. The monetary policy cycle is turning easy, and we expect 75 to 100 basis point rate reduction in this cycle. And that's going to be somewhat positive particularly for urban growth. And then I think you have food inflation is expected to come down from very, very high levels of the last 3 years. And so food inflation coming down means that discretionary spending ability, particularly of the lower households, goes up. And I think if these assumptions play out together with a softer commodity price outlook, I think 6.5 is a normal trend rate of growth. So the economy was growing at very high rates in the last 2-3 years, above our potential, above our trend, and it's now returning back to the trend. And I think we will sustain the trend. That's what we are saying, I think. And in FY26, 6.5 is our base case forecast. And there's so many moving parts. I think the confidence around any forecast is, I think the confidence interval is quite wide. So I think you'll have to play by the ear.
Got it.
I think right now our guidance is that the risk outlook is downward.
Yeah. Well, DK, I will come back to you with your longer term forecast. I take your point on some worries this year, because even our reporter is breaking a news that the US is insisting on zero tariffs on all exports into the United States. So clearly this looks like a temporary reprieve. But let me get Miren into the conversation. Miren, our audience is very much interested in how the corporate sector will do. It's been a wonderful year in terms of the corporates being deleveraged. You're saying revenue growth will be higher for corporates in FY26. Will their earnings also be higher?
Okay, so I think, thanks, Lata. I think, stories like glass half full, half empty, correct? So while the revenue growth will be a tad higher compared to the last year, I think the last year was not very exciting in terms of revenue growth. So it comes on a low base, and it's only a tad higher. So we expect about 7 to 8% revenue growth coming in next year. I think coming to...
1 minute, Miren, you're also saying margins will be higher. So should we expect earnings to be higher?
Yeah, so earnings will definitely, I think the benefit will come from the profitability expansion that we expect.
We expect about 50 basis points higher on the EBITDA side. And given the deleveraged positions of, corporates, I think a lot of it should get passed on in terms of, the net profits as well.
Okay. All right. That will be very big for the markets itself if earnings growth is better. DK, you all are making a point that you expect commodity prices to be lower in the coming year. Where do you get that confidence?
Well, I think one of the reasons is that the petroleum sector is getting a lift by the U.S. Policies, and I think we expect oil to stabilize somewhere below $75 per barrel, which is good for India, which is less than last year. And in general, I think the tariff war also means that there's going to be overcapacity in China, a deflationary pressure, and China is a major consumer and also exporter. So the demand side pressure on commodities will be lower. Food commodity prices are expected to come down as per the World Bank. So there is general drift, lower drift. I think we'll see volatility around commodities because of, I think, different moving parts that are playing out. But the trend, we believe, will be softer downwards, I think, for 25-26.
Okay. Let me come to your, longer-term forecast. Why are you so confident that manufacturing will pick up? I mean, the government in the last 10 years did everything possible. PLI, and even before that, Make in India, Atmanirbhar, higher import tariff protection. In spite of it, our manufacturing GVA, as you point out, has only been 6%. Why should it be 9% in the next 7 years?
Well, I think one of the reasons is that we are improving our infrastructure, our logistics are improving. So that benefit will play out over the next couple of years. Do you have a focused PLI scheme, which will move from towards backward integration, and then the investments on semiconductors and new age sectors are expanding at a faster pace. All that will get reflected in manufacturing. And so there is, as you rightly said, I think despite a lot of attention, manufacturing hasn't done well. But we believe that I think in the new milieu, I think India will also get some opportunity to link up to the supply chains, particularly in segments like electronics and also I think the solar, etc. So there is some shift taking place, I think, which will benefit the manufacturing sector, although the key driver will remain the services in the sense that its contribution to GDP will be higher than manufacturing. But the share of manufacturing, which had been stagnant at around 17%, we expect it to move up to 20% by 2030-31. So that's a very modest increase over in terms of the shares. In terms of growth, so it's also telling you that you need to grow faster in manufacturing to even achieve, I think, to achieve 25% share, you have to grow even faster, I mean, which seems to be out of reach right now.
DK, I'm out of time, so I have to keep this a little snappy since yours is a large report. Miren, which sectors will you bet on in 26 itself, FY26? What are your high growth sectors?
So I think from a, the entire consumption basket from a revenue perspective will grow fast. So be it, your services like airlines, hotels, or on the product side, two-wheelers and consumer durables. I think these are the sectors which will grow fast. Two sectors where we are seeing a rebound on the revenue side, as well as a margin improvement, will be cement and commercial vehicles. So these are two sectors. I think both of them didn't have a good last year. So I think this year we expect a rebound in these two sectors.
Okay, that's good to hear. Miren, which would be the sectors you would be worried about because of the tariff talk?
So, I think pharma, textiles, auto components, and some of the new age sectors, I think these are sectors where we have an exposure to US. Having said that, I think in case of pharma, the likelihood is lower, given the focus on healthcare in US, and also that, any increase in cost, I think government also has to put the bill. So in pharma, the likelihood is lower, but I think, I spoke about components, textiles, I think gems and jewelry, these are the sectors.
Just one very quick last question, Miren. Would you worry that unsecured loans are still high? So in the immediate future, is there any worry about the MFI, NBFC, or even some banks?
Not to a large extent. I think, especially given that rural and urban incomes are expected to go up because of tax cuts on the urban side and the higher allocation to some of these schemes like PMAY, PMGSY. I think even the rural incomes will be higher. So given that, I don't see a big challenge on the unsecured loan side.
Okay. Well, it's a very detailed report of 80 pages. I know I'm not doing justice, but DK Joshi and Miren Lodha, thank you very much for just whetting our appetite. The big takeaway from the CRISIL report is that FY26 can itself be a little dibbly-dobbly. There is a 6.5% growth forecast with, a negative bias. But for the latter part of this decade, the expectation is 6.7% and a lot of betting on manufacturing. We do hope CRISIL is right, but we will read the report with interest. That's it on this edition of It's the Economy. Thanks for watching. After a break, Chartbusters.